Hey everyone, thanks for listening to this episode of Renovate with Ramos. On today's show, James will discuss how to budget and pay for a home renovation project or your custom home build with our guest Ken Sale from Hancock Whitney. Enjoy!
All right, welcome back. I'm here with Ken Sale, good friend of mine and business associate. He is a loan officer with Hancock Whitney Bank. We've done quite a bit together, and I know you do a lot more without me. How many loans you got going on these days?
Generally, we're running somewhere between about 75.
75 at any given time, or is it just a month?
That's the personal pipeline.
Yeah.
Generally monthly because of the type and nature of the product. We're usually doing about 20. I'm doing about 20 that I'm closing out on a monthly basis.
Yeah, so one of the things that many people come to a builder about is how do you build a new home? One thing is the design and the construction. The other piece is financing. So if you come across a home that needs to be torn down, or if you're lucky enough to find a lot these days, Ken Sale is one of few people who offer construction of Perm financing. And I wanted to bring Ken in and talk a little bit about how you assemble that, the time frame it takes, typically, and what are the, pitfalls, the watch outs, and some of the, the pluses about the situation. When you're have the ability to build ground up, it's kind of fun. You just need to be aware of financing first. So
yeah, it is a little different. It's a lot of it's a timing issue. Mm-hmm. As you know, James, when you find a lot. Basically, we'll start with what is a construction perm loan. A construction perm loan is a loan that will allow a borrower to finance the construction of a custom home on a lot they either own or they're purchasing.
Right.
It is different in the respect that the financing goes to the borrower and not through the builder. A construction perm loan, when you picture it, a borrower should picture it just as if they're buying an existing house. Everything's going to happen the exact same way. They just don't get to move in. Now, saying that, if a borrower is out, as an example, and finds a lot in the particular area, and it's got a old home or no home or whatever the case may be, that borrower would go into contract with that lot. They then would come to you and structure a construction contract.
Right.
The lender is going to put those two together.
Yep.
All right. They're going to apply for a loan just as they would any other loan. An appraisal is going to be done in a completed state. They're going to use that lot contract. They're going to use that construction contract, the plans, the specs, and do it just as if it's completed and sitting on the property. So the borrower is going to know exactly what it's worth before we start. A lender is going to use that so they can base their loan on that value.
Right.
Right? You're going to go to a closing. That borrower will. They will put their down payment down. They will sign their mortgage papers. Everything's going to happen just like you're buying an existing house. The differences would start after that. At that closing, that lot that they've chosen or purchased would be deeded into their name. It's paid off and deeded into their name at that time. The balance of the funds to build the house are put aside in what we call an LIP account, which is a loan in process account. Those funds are going to be dispersed in increments as the home is completed,
right,
based on a percentage of completion. The borrower, even though the loan is closed, does not start making full mortgage payments. The borrower is responsible for the interest only on the amount of money as it's dispersed on a monthly basis. So those payments are going to be very small to begin with, and they're going to slowly get a little larger as we construct the home.
Yeah, so let's do an example. So let's say a buyer finds a $500,000 lot and they get it under contract. They find a design builder or an architect. You need to end up with a contractor, but let's say they draw up a design for $1 million home. So how would that work?
Right. Basically, in that, just as if you're buying an existing home, you can't buy the house without the land. So we've got a $500,000 lot. We've got a $1 million contract to build. We've got a $1.5 million package.
Okay.
On a $1.5 million package, we can loan up to 80% of that.
Okay.
So the loan amount would be 1.2. At that initial closing, the borrower would put their $300,000 down. The lot would be paid off because we'd disperse the other $200,000
right? Yep.
to pay off the lot and deed it into their name, and then we'd put the $1 million aside to be dispersed in those draws. As that draw process continues, the borrower is going to review it. We're going to verify the subcontractors are paid. We're going to get the notarized lien waivers. We're going to do what we need to do to protect all parties. At completion of that home, the borrower is going to then do a walkthrough through the house, make sure they're happy with everything. The loan then modifies to a permanent loan. There's no additional closing costs at that time. It's a rollover modification. So basically,
which is a huge benefit.
Yeah,
So
which
you're not
basically
closing
a
the second
construction
time.
perm
Right.
is one loan, but it has two phases.
Right.
It has a construction phase and then a permanent phase.
Now, are you able to lock in their rate?
That's another benefit of a construction perm. You can lock in the rate right up front. So you're locking in a rate today, which is a huge benefit today because you're locking in a rate presently that you're not going to be able to move into that house for 12 to 18 months.
Right.
The additional benefit is that even though you've locked in the rate today, at completion of the home with us, if the rate is lower, we'll modify you to that lower rate. We just guarantee you not to go up.
Right. That's great. That's great. And let's talk about timing. So, let's say today, what's the date today? Or let's just say, January 1, you find a property, you put it under contract. What should a buyer, a client of yours, be expecting from a time frame?
The biggest issue
closing?
with that when you're trying to do two contracts,
Right.
find a lot in a house,
Right.
is the timing. You need to allot enough time on that lot contract to be able to structure a construction contract with a builder, because a lender is going to need to put those two together.
Right. So you can't order an appraisal until
Right,
you have
and
both.
it's the timing is going to vary depending on where that borrower is at in the process with a builder. But they're going to need to be able to, generally a lot contract closing will be 60 days. So if you're going to sign that contract, you need to be able to get with a builder and structure a construction contract within 30 days to be able to complete that and close within 60 days on the package.
Okay. So you need at least 30 days from the time.
Generally, because you're gonna need an opportunity to get the appraisal completed,
Right.
And in the current market environment, appraisals are running 2 weeks,
Yeah.
2 to 2.5
Yeah.
weeks.
Yeah, so immediately, so when the buyer actually has the contract on the land, they can start sending you their financial package.
Right.
So you pretty much have an idea quickly as to what they can afford. And then in parallel paths, they're working with their builder, their architect to do the design plan. And then the builder, gets the result there and puts a package together. So you need a from a plan perspective, you need the elevations, you need a floor plan. You don't need a full permit set of plans.
Correct.
And then you need a specifications document and you need a signed contract.
Correct.
With the builder.
And generally, I recommend the borrowers, first of all, get pre-approved so that you do know
Right.
what your
Well, these
borrowing
days,
power
most people
is.
should do that.
You should do that because you don't want to spend a lot of time running around, putting offers on a lot. When you do, they're going to want a pre-approval letter. 2, you need to know how much money you can afford with that builder. You don't want to go and design a $2 million house if you can only afford $1 million.
Right.
So do that up front. And as part of that process, once you find the lot, we begin gathering documents. We start the financing side so that we can have things running parallel to the construction contract so that we can shorten that time frame as best as possible. Initially, we will go with a preliminary number. How much are you planning to spend? What's your upper limit?
Right.
Once you derive that contract with that builder, we'll then go in and tweak and modify the numbers to match that contract. That way we can immediately order an appraisal and move forward.
Excellent. Excellent. I'm here with Ken Sale from Hancock Whitney in Tampa, Florida. Ken Sale's been in the business for over 30 years, right?
38
years
now. Yes.
You've done a few. And you have an accounting background, right?
I do. Yep. My major is actually in finance. My minor's in accounting. Correct.
Yep. Good stuff. So he can read the most complicated of clients, and understand it pretty quickly. But here with Ken Sale from Hancock Whitney, and we're talking about construction of perm loans. Thank you very much. Some of the summary of the benefits are you're going to close one time. You have the ability to finance something that's not been built yet, which is fantastic, and you can lock in your interest rates for the period.
Technically, we do an initial 75-day rate lock to give our clients time to work with the builder.
But once you close, you're good.
Once you're closed, that loan's closed.
Yep.
You can go down, but you cannot go up on the rate.
That's great. Good stuff. Good stuff. Thank you very much, bud.
Thank you.